Welcome to the Explainer! Alright, today we're tackling a concept that honestly sounds like some intimidating, high-level Wall Street mathematics, but is actually one of the absolute most practical tools you can use for your everyday investing. We're going to completely demystify beta and transform it into a totally actionable metric for your own portfolio.
Okay, let's dive right into our roadmap for today. We'll start with the basic intuition of market risk, look under the hood at the math, figure out what those numbers actually mean, and then wrap up with some actionable portfolio strategies and, of course, the metrics limitations. Let's get to it.
So, first things first, what exactly is beta risk? Well, to really get this, we've got to nail down what we mean when we talk about market risk.
I want you to think about the stock market like a massive, unpredictable ocean. The individual stocks, they're just boats floating out there on the water. When the tide comes in, or some huge macroeconomic storm hits, the whole ocean moves, right? And those boats, they literally have no choice but to react to those giant waves. That overarching tide, that's what we call systematic risk.
And that brings us to our definition. Beta, usually just written out as the Greek letter beta, is simply a statistic. It measures how much an individual stock's price is expected to swing in proportion to the broader market. Now, it's absolutely crucial to remember here. Beta only cares about that systematic, non-diversifiable risk we just talked about. It completely ignores isolated idiosyncratic risk. So, a terrible earnings report, a weird supply chain glitch, a CEO scandal. Beta doesn't care. It solely tells you how much a stock gets pushed around by the ocean's tide. To make sense of this, we need a baseline. And that baseline is exactly 1.0. The broader market itself, which we usually proxy with an index like the S&P 500, is the ultimate anchor. It always gets a beta of 1.0, period. Every single other asset out there is then measured relative to that one number.
All right, let's move along and see how this actually builds. How do we do the math to find this number? If you open up any standard finance textbook, you're going to see the traditional academic formula. It calculates beta by dividing the covariance of the stock and market returns by the variance of the market returns. Basically, it's just mathematically asking, hey, how do these two things move together relative to how volatile the market is all by itself?
But honestly, there's a way more practical way to approach this. While academia loves that covariance over variance method, real-world practitioners almost always rely on linear regression. It's so straightforward you can calculate it yourself. Seriously, if you grab the historical returns of a stock and the returns of your market benchmark, drop them into Excel, you just use the slope function. Easy.
And this brilliantly illustrates what that slope actually represents. If you map it out on a scatter plot, putting the asset's returns on the y-axis and the market's returns on the x-axis, you can draw a regression line straight through those data points. The steepness of that line, that is literally your beta. A super steep slope, high beta, meaning it's highly sensitive to whatever the market is doing.
Okay, so the math spits out a number, but what do these numbers actually mean for you as an investor? Let's break down the ranges. If you've got a high beta, say anything over 1.5, like Tesla sitting around 1.8 or Nvidia at 1.7, that asset is volatile. If the market goes up 10%, a 1.5 beta means you'd expect that stock to jump 15%. But if the market drops 10%, it drops 15%. Now, as we said, a beta of exactly 1.0 is moderate. It moves in lockstep with the market. Drop below 1.0 and you hit moderate low-risk territory. Think Johnson & Johnson at 0.7 or your standard utility companies. The market swings 10%, they might only move 7%. And yes, you can absolutely have a negative beta. Things like gold or inverse ETFs actually tend to move in the exact opposite direction of the market benchmark.
To make this really stick, let's bring it back to our ocean analogy. High beta stocks, those are your speedboats. They are launching off the waves, giving you a totally thrilling but very bumpy ride that amplifies everything the ocean does. Low beta stocks are your massive cargo ships. Heavy, steady, they just cut right through the chop without bouncing around too much. And those negative beta assets, those are your submarines. They're cruising along, moving entirely against the surface currents. So, how do we actually use this? Let's get into the really practical side of things, portfolio management and hedging.
Figuring out the overall beta of your entire portfolio is a surprisingly simple three-step process. First, just identify the beta of every individual asset you're holding. Second, determine the percentage weight of each of those assets in your overall portfolio. And third, just calculate the weighted average. That's it. Your portfolio's overall beta is simply the weighted average of all the individual betas tucked inside it.
And here is why that matters so much. Asset blending drastically changes how you'll experience a sudden 10% market drop. Imagine you're 100% invested in those high beta speedboats, giving you a portfolio beta of 1.5. A 10% market crash? Ouch. You're looking at a painful 15% expected loss. But if you actively mix things up, let's say 60% broad market funds and 40% low beta utilities, your overall beta drops down to 0.76. Suddenly, that exact same 10% market crash only results in an expected 7.6% loss. Those low beta assets act as a literal shock absorber for your money.
Now, advanced investors take this a huge step further to aggressively hedge their risk. They'll actively blend high and low beta stocks, or maybe use inverse ETFs to balance out a really heavy aggressive portfolio. Some even use futures and put options to hedge out systematic risk completely. Like if you know your portfolio's exact beta, you can actually calculate the precise hedge ratio you need. You'd short market index futures or buy put options in exact proportion to that beta. Boom. You've effectively neutralized a market drop and locked in your profits. It's incredibly powerful stuff.
But listen, as powerful as beta is, it is absolutely not a flawless crystal ball. Let's talk about its limitations.
What's really fascinating here is that historically, regression betas for US stocks have massive standard errors. That means the range of what the true future beta might actually be is often uncomfortably wide. So let's say a stock's estimated beta spits out as 1.1, but the standard error is huge. Well, actually scratch that. If the standard error is large enough, the real working beta could literally be anywhere from 0.7 up to 1.5. It's kind of a massive margin of error.
Because of those huge standard errors and the fact that, companies naturally mature and stabilize their business models over time, professional platforms step in and make adjustments. If you look at a Bloomberg terminal, for instance, you'll see a metric called adjusted beta. What they do is take that raw historical beta and mathematically shrink it closer to 1.0. This adjusted figure is generally considered a way better predictor of a company's actual future risk profile.
So, just to summarize, there are a few fundamental flaws you absolutely have to keep in mind. First off, beta relies entirely on backward-looking historical data. It just assumes whatever happened in the past is exactly what's going to happen in the future, which we know isn't always true. Second, it completely fails to capture company-specific risks. A low beta is not going to save you if a company suddenly gets hit with a massive existential lawsuit. Third, it gets totally distorted by changes in corporate debt. If a company takes on huge leverage, its historical beta is instantly useless. And finally, it can be wildly misleading in emerging markets. If just one megastock dominates the local benchmark index, it completely skews the baseline.
And that brings us to the end of this explainer. But I want to leave you with one absolutely critical question to think about today. What is the beta of your financial future? Seriously, I challenge you to audit your own portfolio this week. Are you captaining a highly sensitive fleet of volatile speedboats, or are you safely loaded into steady, reliable cargo ships? Getting a grip on your personal sensitivity to the market's overarching tides is literally step one to truly taking control of your investment risk. Thanks for hanging out with me on The Explainer today, and keep learning.